There is gold under a bit of pressure. We got this pretty bearish call from Citigroup that the precious metal is likely to sink down as low as 2,500, maybe lower next year. But that's after a record-breaking run. Our guest says silver could be the next winner in the commodity rally. Let's get more from Brenda O'Connor Juanas, Senior VP and Financial Advisor at UBS. Thanks very much indeed for joining us, Brenda. What is your thought on gold before we get on to silver? Is gold a bit of a one-way trade right now?
Well, look, we have gold up and around 3,400 here. Now, if this tension broadens out into a regional war in the Middle East, I think we could really aggressively go through our year-end price target on the commodity, which is 3,500. At the end of the day, though, for me, gold still is an appropriate hedge when there's this type of geopolitical dislocation, and there are still strong fundamentals that are underpinning the commodity. As an example, we now know that gold has displaced the euro amongst assets owned by global central banks, and I don't think this trend is going to dissipate, especially as these chatters around de-dollarization will continue. So we still like gold. Mm-hmm. Now, on your point with silver, everyone's sick of talking about gold. It's been one of my big calls for the last 18 to 24 months. So for those investors, I am encouraging them to look at silver. Of course, silver doesn't have the same safe haven attributes that gold does, but we think that the commodity has upwards of 8 to 9% upside this year on the back of some technicals, as well as the general fact that it is underowned.
Silver, I mean, certainly it's a smaller market, a less liquid market. And I don't know, do central banks even hold silver reserves? I should look into that. But you do see, if you were going to bet in precious metals right now, silver would be your choice.
Yeah, I think gold for hedging purposes, silver for a pure upside play.
What's your take? I mean, I know it's impossible to know where this Middle East conflict will go. Some guests have told us on BNN Bloomberg, we've seen violence in the Middle East before. The stock market eventually shook it off. Is that going to happen again this time?
So it has been a pretty wild week geopolitically. Of course, things are moving very quickly in the Middle East. I don't know at this point if this is going to turn into a broader regional conflict. I think there are very few off-ramps that are obvious at this point. Mm-hmm. So what I'm telling my clients is to focus on what is actually going to be the impact to the broader economy. And when it comes to this, it's really two things. It's the impact to oil and the impact to trade. And right now, I think that they are both muted. Now, look at what the market has been telling us in the past few trading days. Mm-hmm. Yesterday, we saw risk assets really rally, which is indicative in a way that markets are looking through this noise and do not think that there's going to be a significant impact to the global economy or to the U.S. economy. I also thought it was pretty interesting on Friday when I was looking at those safe haven U.S. assets. I'm talking about treasuries in the U.S. dollar here. We did not see a strong rally. So I interpret this as, number one, markets not panicking. But I do think there's a question mark here, Andrew, around the talks of U.S. debt levels that we've seen in the last few weeks. So I think that that is an area to watch as well, the movement of the treasuries in US dollar.
You do say that global stocks at least offer what you call a valuation cushion. They're more reasonably priced.
Right. So our UBS call on U.S. stocks is 6,400 to June 2026. For me, however, the valuations are more attractive in international stocks. A few examples for you. So if you look at Europe, Europe is trading from a valuation perspective at a 9% discount to its history. You have other geographies in the world, whether it be Japan, emerging Asia, that have really strong earnings momentum. They also have the tailwind from monetary policy, which we're not seeing here in the U.S. yet. And so to put this into context, from a forward PE perspective, non-U.S. stocks are trading at 13 or 14 times versus the U.S. at 21 times. And that is just a more attractive and easier entry point for me.
And you know that European growth right now matching the U.S., and that's been rare over the past 3 decades.
right? It's only happened a few times. So the fact that the fundamentals underpinning these economies, these large economies, in addition to just pure valuations, is another supportive point of why I would look to regions like Europe.
You and a lot of other professionals are getting interested in so-called alternative investing, which can include private debt, private equity. Why do you think there is so much interest in this area right now?
I do think it has a lot to do with what we see as our capital market assumptions. So our best guess of what returns are going to be in the next business cycle. And if we think that equities are going to be more muted, I'm now turning to alternatives, both from an income perspective, but as well as a return perspective. So let me break it down for you. I like private credit right now for yield. I think that this environment where we still have heightened rates in the US, where the default backdrop is still muted, is going to give private credit managers the ability to deliver 9, 10, 11, 12% returns to their investors. You know, switching gears to private equity, I like private equity for different reasons, but equally good ones. You know, from a diversification perspective, the one thing that we've talked about before is how concentrated the U.S. markets are. You have those top 10 companies comprising 35, 40% of market cap. So I know that I'm going to need diversification, and I'm looking to the private markets to do that. I also like the statistic that since the 1990s, there has been a decline of 40% in the number of public companies in the U.S. So if you are an investor that really wants broad-based U.S. economic exposure, you're going to have to look elsewhere, and privates is one of those places, private equity. And then finally, I would say that when you see public market dislocation like we've seen this year, it often translates into outperformance in private equity of 500 plus basis points. So I think from a timing perspective, this vintage, as maybe is the case with 2024, will be attractive in 5 to 7 years when these funds start distributing back to investors.